Hello, today is Sunday. It is the 30th day of December 2012, and welcome to today's video, the final one for the year 2012. We'll look at this gold chart, which is a yearly chart, put some indicators on this. Look at the monthly chart, the yearly chart for silver, and the final 2013 prediction regarding the Fed. Okay, so let's get this started. This is 100 years, and this pretty much goes back to when the Federal Reserve took place, as it's now been almost 100 years since they've been in the market of currency. Anyway, let's take a look at this. Obviously, going sideways, the gold confiscation, and then stealing their wealth with this individually. I think it's a one-day move back in the day when they took it off the gold standard. The price got fixed from 20 and change to 35, and it stayed that way for quite some time. So you have the uptrend, sideways consolidation, uptrend. Very much a basic just by looking at this. It's also the 12th consecutive up year, and it's up for the year at 89.10. So as long as it doesn't lose $89.10 on Monday, it will be the 12th consecutive gaining year, and it's a gain of over 5% for the year. And it's also below last year's high, and I talked about this in my previous gold video a few weeks ago, and above this last year's low. So we'll talk about that, but that's an inside year, which is a very much one of those situations that tell us, okay, what's the trend? It's a consolidation within the trend. Well, the trend is higher, so it's a consolidation within the uptrend. And it's overall a bullish situation coming off what we're seeing so far. But let's put some indicators on this. And this is what we're going to put in. We're going to put in the 18 average of highs, lows, and closes is front weighted. We got an upper band and this lower band, which means it's been riding this upper band for several years. It's pretty much started here, so 3, 4, 5, 6. This is year 7 of getting close to it, but it didn't actually touch it this year compared to the previous years where it hit it every single time because, of course, it made a lower high this year. The other indicators have a front-weighted, or excuse me, a running average from this high of 850. So this is the average, and then boom, back up again. So therefore, when we take a look at this, it got above it here, and then finding support here. And this pretty much was a confirmation saying that this was a failed move. So at the end of this year, when gold was 500 and change, that was telling us, okay, it looks like the selling from 850 down to 250 is looking to be a failure. And obviously, sure enough, it was. And the Fibonacci retracement that I'm using is from this high to this low. So I'm not going to do any of the 38.2, 61.8. Instead, the 161.8%, which means I take this high and divide the low. And that's going to come to a little over 3. And I put this to the power of 161.8%, or 1.618. Multiply the low again, and you get 1,803. So it's an area, of course, where it's found some resistance just a little bit. But when you look at this on the yearly time frame, it's something you want to look at for years. If, of course, it stays going sideways. If it pulls back, then you'd be looking back to this level here. But I do like the odds that it goes higher because you got 12 consecutive up years in a row. So by stating that it's not, you're pretty much going against the grain, going against the trend, and to me, that's just pointless. When you throw the inside year in from the previous year, I do like the chances that not only will it be an up year, but it should easily break 2 and probably even close above 2. But we'll wait and see how, of course, the year progresses. Okay, so let's put some statistics on now, some Fibonacci stats. And last year, the high was 19.20 and 80 cents, and then the low was a little over 13.07. This year, the high was lower at 17.92, and the low at 15.26. So this year's low is a 40.3% retracement from the previous year's levels. And that is the, from this high and this low, at 15.26, all that was 40%, which meant that it held the 38.2% level all year long. And the high was 82.0%, which is quite high, actually. And the average going just about a week and a half ago for the year was 1669.41. So we're a bit below the average price for the year, pretty much in or around it. But that level is a 63.5% retracement, which means it's been steadily holding 61.8% from this high and this low. And I do like that bullish sign as we move forward. The next level of 261.8%, I haven't calculated it yet, but you can expect it to be decently high. But I haven't calculated that, something I'll do later on. But the answer for that is 850 divided by 251.7 to the power of 2.618, multiplied 251.7. That would be the next level I would expect this to go. If it has a confirmed breakout, you really have to see it breaking well above 2,500. Okay, next one would be the monthly chart for gold. And obviously, this is just a consistent uptrend. But when you have 12 straight years of going up, that's what you got. You can say, well, this trend line is broken, but since it's broken the trend line, you have another uptrend line. So yeah, it's broken, but the rate of ascent has done nothing to be damaged, just a little slow. And you can even look at different trend lines like this. It's right on it. It's still holding well above this. That's just basically it. And the Fibonacci in this one will be from this high to this low. So what we're going to do is a 161.8% level, which was obviously not resistance. It broke through and it found support. When you either don't get resistance at it and it either keeps going higher or it finds very quick support and that's it, and then you usually expect it to have a decent time move to the next level, which means should get there relatively quick, not so many candles. So on here it was 7 or so, 8, got up to here. Now that's a little short because the high for the year was 1920, and we got up to 1956, or 1956 was the level. So that's about 36 points off, or about a little under 2% of a pierce below. So a decent sized pierce below this line, but close enough. And there's, of course, the sideways consolidation pattern that it's currently playing in. I guess if you do have any further sell-off, it's basically this level here. I've been saying that for quite some time, and I still don't think that's going to take place because here's what's going down on Monday. The debt ceiling is it's hit its limit, basically, and that's probably going to make the markets a little volatile. Therefore, it's a decent chance that actually gold and silver will go up or at least stay sideways when this stuff is going on, because the debt default is actually bullish for gold and silver. Now, I don't think, of course, they're going to default on it. I'm making a prediction within the Fed. That's probably the easy one. I'm not going to officially make it, but don't expect them to default on the debt. It's the same old story. It's going to be raised again. We went from like 14 point something, like 14.2 to 16.4. So now you got to expect it to go to 18.7, 18.8. Maybe they'll step it up a bit, do like make 3 or 4 moves to get it there over 3 or 4 months, something like that. I don't know, but I fully expect that to go up. So let's now take a look to silver, and we'll look at silver on the yearly time frame. That's the only one that I'm going to show is the yearly chart for today, of course. The Fibonacci retracement that I have is from this high and this low, which is 165.25 from the big old crash of 1932-33. Anyway, 161.8% is $5.30. An area that was resistance for a little bit and then had a fast move up to the next level, which is 35. Massive support back here, and now testing this level again. It's interesting how those levels are working out very well, though. The next level is the 423.6. Again, you take this high, you divide the low, and in that you're going to get a little under 7. And you multiply put to the power of 4.236, multiply the low, and that number will come up to around 740 as the next level. But we're looking at the yearly time frame, so you got 4, 5, 6, 7 periods to get there. So that takes us to like 2018, 2019. And we've already seen it can do it in one period in previous year analysis. So that's just something just to point out anyway. But you know what? Normally, from what I noticed, it's usually these two that are the really only relevant ones, the 161 and 261, because after that, it kind of gets out of hand. But if it does get out of hand, that would be interesting to see if it does go to that 750 area, in the area of basically 650 to 9. But anyway, that, of course, is long-term analysis, which really is what this is all about. We got two sideways consolidation candles from this move in here. So we get the exact same consolidation after you've had a uptrend. And that will be it for the silver charts. Now let's do the final prediction for 2013. And as I've been stating, it's the 100-year anniversary. So on December the 23rd of 1913 was the start. So that was the 100th year they were in business. There will be very little to no remarks within this anniversary, both on the mainstream media as well as the Federal Reserve Department. This means you will not be able to go to the Fed's webpage and see something with 100 years, like many businesses have done in the past. You know, some sort of logo. Maybe they have some sort of reference. Oh, 100 years of great service and all this, yada, yada, yada kind of stuff. You're not going to hear anything from that. And that means when you watch all these when you go to none of the alternate media sites and you go to the mainstream web pages or see their newscasts, you'll hardly get anything at all about 100 years. It's something, if you watch it all the time, you may catch a few times, but that'll be it. So I doubt that they want people to be interested in the knowledge, which is, I think, the reason why that'd be the case, because if they really publicized 100 years of the Fed, that means people would look back and see what happened in 1913, and they maybe accidentally might stumble on to things that happened in the 1930s or in the 1960s, and then that might be interesting if they figured some stuff like that out. But my prediction is not based on the reason for why it's not going to be in place. Maybe they'll just flat out forget it was 100 years, if that's the reason. I don't know. It's not based on that. It's just on the actual fact that it will not be done. So thank you for tuning in to the final video of 2012, and I'll talk to you in 2013. Bye-bye.